Welcome. Today we're going to be showing you why you should never pay cash for real estate and how you can put an extra $131,000 in your pocket.
I tell you, I get this question all the time. I want to invest in real estate. Why should I run it through a policy or using the infinite banking concept? And that's what we are going to explain today.
Absolutely. We're going to be touching on real estate investing and infinite banking and the great AND1. I'll tell you what, real estate investors are already playing this game, and today what we're going to do is we're going to show you guys how to do it.
Perfect.
Yeah, play the same game with infinite banking and get your AND1. A lot of people are probably thinking, what is an AND1?
Yeah.
And everybody knows that Anthony is a phenomenal basketball player. We covered that in one of our podcasts. He's got an amazing jump shot. But for those of you that don't know, when you're playing basketball and you take a shot and you get fouled and the ball goes in and you score, you also get sent to the free throw line to shoot a free throw. And so that's called the AND1. And so it's an extra point in addition to what you're originally doing. So we're going to go through and show you how to combine these two strategies.
So today what we're going to talk about is some of the advantages of investing in real estate, advantages of infinite banking, and then we're going to share a case study.
Awesome. And again, this is going to be based upon Nelson Nash's book, Becoming Your Own Banker. This is the foundation of a lot of the strategies that we use and a lot of the strategies that our clients are using.
And in this call, we're going to talk about how we can incorporate by using infinite banking and real estate to get the AND1. So this video is not going to talk about infinite banking. So maybe if you don't already have some knowledge in there, we did a video that explains infinite banking in 12 minutes. That'll give you a good foundation. But so I would recommend that you watch that video after this one if you haven't.
Awesome. So let's get started. So we've got some advantages while people buy real estate are, as we've listed here below. One of the first ones is going to be appreciation. Appreciation is just where your house increases in value every single year. Typically, kind of on the low end, most people assume a 3% appreciation annually. Equity, right? Equity is value that's found in your house. You can leverage against it. You can cash out. You can take some money out. But it's really just any value that you have in your home. Cash flow is any money that's coming off some sort of investment on a monthly basis or annual basis. And then everybody understands that we've got a whole bunch of tax advantages that come along with real estate. And I believe that capital gains are one of the lowest income taxes that you're going to pay. So
we also have that depreciation where you're able to depreciate the value of that home. And oftentimes, if you buy it right, that depreciation is going to offset a lot of your cash flow. So that those first early years, you're not going to be paying tax on all the cash flow that you receive.
Yep. And then we also have leverage, right? Leverage is one of the crucial pieces to creating wealth. Whenever you look at somebody that's created a whole bunch of wealth over one lifetime, real estate's always involved, and leverage is a big piece of that. An example of leverage is what we talk about is taking a small down payment and purchasing the full asset, and you get the tax advantages of owning that full asset. So that's an example of leverage.
And so what most people do, they put let's just use an example of $100,000. They put that in real estate to get all of these benefits, which are great. But one thing we're not getting is the AND1. We're only getting these benefits. But with infinite banking also has appreciation. There's guarantees and potential for dividends in there. So there's guaranteed to increase each year. Inside there, you're going to have equity in the form of cash value. In regards to cash flow with real estate, which that's one of my favorite reasons why I like real estate, but also you need to have some liquidity. Because if you have real estate, there's going to be some vacancies, some repairs, some capital improvements. So we need to have some cash liquid, either to help properly service that property, or maybe more importantly, getting ready for the next deal. And you can store your liquid assets inside a policy, and policies are earning between long-term between 3 and 5%. So we're just using an average of 4. When compared to the liquidity that you're probably using with your real estate is probably in a bank, right? Earning 0 or next to nothing. But also there's tax advantages of infinite banking and using life insurance. That growth at 4% is going to be tax free. So that could be the equivalent of maybe earning 6 or 7%, paying the IRS and being left with 4. Okay. But real estate, as Cameron mentioned, had some amazing tax advantages. Probably one of the single most asset class I've seen with the most tax advantages. And if there's one that comes in second, or I don't know who's first or second, but it's a close race between the tax advantages of life insurance and real estate. And when you can combine them using the infinite banking concept, I truly believe that you're taking full advantage of the tax code. Now, you can also leverage the policy, and that's leveraging is what we're going to go. That's what that video, that 12-minute video that you should watch is going to dive a little bit deeper into that. But this is the beauty of this policy, is that we're not telling you to put the money in real estate or infinite banking. There's the ability to do both. We can leverage the policy to invest in real estate. Also, another great thing is asset protection. Yep. Right now, each state has some level of asset protection. Many, like Nevada and Texas, have 100% asset protected, meaning if you get sued by a tenant or some sort of creditor or vendor, they're not going to be able to come after the equity that you have inside your policy. Now, what we're going to show you, and we're going to do the math here, is what we're proposing, instead of before you put the money in the real estate, is you put the money into a policy, then you get all of these advantages. And then we can leverage against your policy to buy real estate. And then we can get all of those advantages. And that's how we're going to get the AND1.
Perfect. Awesome. So now we're going to dive into this case study for you, and here's some of the specifics that we're going to look at. We're going to look at a purchase price of a $100,000 piece of real estate. We're going to assume 3% appreciation. We're going to look at it over a 30-year timeline, and we're going to assume monthly cash flow of $1,000. So let's jump over to the cash side of it first. If we calculate the appreciation on this asset, on this house, let's go through the numbers. We got $100,000 appreciating at 3% over 30 years. So we're going to look at the numbers. We have in this example, we have a $100,000 house. We're going to assume that we have appreciation of 3%, and we're going to look over a 30-year time frame. That gives us $242,726. So we just did the math showing the appreciation, and we came up with $242,726. And now if we jump down to the cash flow, we've got $1,000 a month coming off of this property over a 30-year period.
Do you need me to do a calculator on that, or do you got this?
$360,000. Okay. And then if we subtract our purchase price of this house, which is $100,000, we have a total return of, drum roll please, $502,726. Now that's pretty straightforward. That's what everybody's doing, right? And so what we're talking about is changing the order in what people are doing. Most investors are just going straight into cash. What we're showing you guys is that if we move into an insurance policy first and take a loan against it, we may come out ahead. We'll see.
Right. So, and one note here, we're just using an example of $100,000. And we're using an example of rental property, but there's an infinite ways to use this. It could be any other cash flowing asset or any other asset here, and you don't need to pay for in this example we're buying one house for $100,000. But Cameron, couldn't we just use that $100,000 as a down payment and buy 4 or 5 houses?
We should. We would typically recommend, if we have $100,000, go buy 4 or 5 houses at $20,000 each with a down payment.
Now, why would you recommend that as opposed to just one?
Sure, we are spreading out our risk into 4 different properties. If we only have one and we have a vacancy in one of them, now we're out. I'd rather have 4 or 5 different properties, and if I've got a vacancy in one over here, I can kind of make up for it in the others.
And I also add on there, now instead of appreciating on $100,000, we're appreciating, let's say we buy 4 houses. That means we're appreciating on $400,000. And also with right now with interest rates so low,
Yeah.
if you can get a 30-year fixed mortgage, that's going to be some cheap money, and that's tax deductible. So that's only going to allow you to increase your returns. And so we get this all the time. I just want to buy the house.
Yeah.
I don't want to have to repay the policy. It just doesn't make sense, right? But what we like to say is we do the math. So we just did the math on paying cash. Now let's do the math on using the infinite banking policy. So Cameron, what's the appreciation going to be?
The exact same.
Okay.
242,726.
Okay, perfect. Okay, so the appreciation is still the same. What about cash flow?
Cash flow is going to be a little bit different.
And why?
Because now what we've done is we've taken a loan against our insurance policy, and so we need to account for that. We've got to set up a loan repayment schedule back to the policy to replenish those funds.
Okay, so let's do the math on what that looks like.
All right, so now, Anthony, you're doing the math on the loan repayment, correct?
Yeah, so we got having a loan for $100,000. And we're going to say, like, typically right now, insurance companies are charging 5%.
Mm-hmm.
And we're going to use 360 months just because that's what is more typical for a mortgage. But, Cameron, what are the requirements to repay this loan?
There are none. You could dictate your loan repayment schedule to whatever suited your needs.
Right, so we're just going to do the math and say that you're spreading it over 30 years, but you can pay it off faster, you can pay it off longer. A lot of our real estate investors are just paying interest only. So there's a lot of options here. So we have a payment here that we're going to have to pay back to the insurance company. So now let's see what our monthly cash is going to be. Thus, right now, the payment we're going to pay back to the insurance company to the use of their money is $536 a month. So what we're going to do, if we're getting cash flow of $1,000, right, we need to subtract out the loan repayment. Subtract that out. So our net cash flow each month is going to be $463, and we're going to times that by 360 payments. So that's going to be $166,000 is going to be our cash flow. Now we start adding these numbers together. Okay, now we have a total return of $409,000. So if this was a race, right, and we were to take a snapshot of where the race is right now, who's ahead?
Cash.
Right? Cash. And this is where most people get hung up. And this is where they stop. Well, I got that payment that I have to repay the policy. Why would I ever do this? But they're missing the big picture. This is only a snapshot of one piece of the puzzle. Because Cameron, what else are we not accounting for?
We have not accounted for the cash value growth inside of the policy.
Cameron, what's going on inside our policy?
Our policy is sitting there. Our cash is sitting there, continuing to compound and grow year after year. And if you have any questions on that growth, again, we did do a video on it, on how infinite banking works. Make sure you check that out.
Well, Cameron, how is it growing if we took out $100,000?
Good question. Is we took a loan against our cash value, Anthony.
Big difference being against, meaning the money, that $100,000 is still in there. It's still compounding. We just leveraged against it. So let's take a look at what's going on inside the policy. So what we look inside our policy, we just do some simple math. We have $100,000 in there, and it's compounding. We're going to use 4% for 30 years. So that means that policy is not $100,000. It went up 4% compounding for 30 years. So with our net return of 409, we have to take a look at what's going inside our policy. It's no longer $100, it's $324,000. And again, we need to account for the $100,000 that we originally put in to that policy. So now our total return, drum roll please, maybe, is $633,000.
Wow.
If we take a picture of this race, who's the winner?
Infinite banking strategies has now beat the cash option by $131,000.
Now here's the question: did that person put more money into this equation?
Nope.
Did we change their cash flow at all? Did
Nope.
they work any harder?
No.
Did they take on any more risk?
No.
And they made an additional 26%, which is what we call the AND1, right? And here's a question: who paid less in taxes?
Oh, the infinite banking.
The infinite banking, because the difference between the cash flow, the 360 of cash, and the 166 infinite banking, that was interest paid on the mortgage. And when you use infinite banking through business purposes, that interest is tax deductible.
Great point.
So not only did they make another $131,000, they also had deductions of about another $200,000. So so whatever tax rate you're in, you could add that to the increase. So here's an example with infinite banking. Again, this is an and asset. We want you to invest in real estate, and if you use a policy to finance that, you're going to pay less in taxes, and you're going to have more money at the end of the day, and that's what we call the AND1.
Well said. Great video. Hope you guys enjoy it.
Now, if you want to learn more, like and subscribe. And I'd also suggest you can check out our podcast, the Infinite Wealth Podcast. And if you think maybe infinite banking might be for you, in the link in the show notes will be a link for you to get on a discovery call with Cameron or I, just to kind of see if infinite banking is for you. Go make it a fantastic day.
Take care.